Okay, so this analysis report is an aggressive, high-energy bull case for AMC.
It really is.
It argues that the recent defense of the 150 support level is a big technical reversal, and it's aiming for a $3 target based on some huge 2026 box office catalysts.
Yeah, that headline, breaking. AMC defends key support. Next stop, $3.00. It just grabs you. You immediately get that sense of urgency.
Totally.
It's got this great engine, strong technicals, massive future fundamentals. But I think we need to work on the transmission, just to make sure all that power gets to the road.
Exactly. And I think the biggest opportunity we see right away is structural. It's about integrating those two timelines. The report really needs a stronger narrative bridge to connect that immediate short-term technical signal to the long-term fundamental catalyst.
I felt that disconnect immediately. The flow is just a little jarring.
How so?
Well, it dives deep into the immediate price action, right? The bounce off 150, the potential for a breakout at 170, all the squeeze risk stuff.
All the technicals.
All the technicals. And then, bam, it just pivots straight into the fundamentals. But they're all based on the 2026 supercycle movies.
That abruptness, it creates this huge 2-year gap in your mind. And I think it splits the audience.
It does.
I mean, if I'm a short-term trader, I'm focused on that 150 defense. Why do I care about a movie slate 2 years from now?
And the other way around, too, if I'm a long-term investor looking at 2026, why is one single day's technical hold so important to me?
Yeah, it unintentionally forces you to switch hats right in the middle of the analysis.
The weakness is that the 150 hold just feels isolated. It feels separate from the 2026 potential.
So the suggestion is to build that bridge.
You have to. You need to introduce an explicit narrative that makes that current technical strength a strategic necessity for the future.
Okay, so the 150 defense isn't just a trade.
No, it's proof of the company's ability to survive until the 2026 payoff arrives. That makes the whole argument relevant for both traders and investors at the same time.
Right, so the technical floor becomes about something much bigger. It's about existential survival for the entire bull case. You turn a chart pattern into a strategic update on the business.
Precisely. So instead of just jumping straight to the movie montage, you add this intermediate step.
And what's that step?
You frame the defense of 150 as critical evidence of the stock's stability. Argue that holding this floor is what minimizes the risk of dilution, of any kind of financial distress that could stop the company from actually capitalizing on that 2026 supercycle.
We're talking about huge films here.
Massive. Super Mario Galaxy, The Mandalorian and Grogu, Avengers, Doomsday. You make it clear that holding 150 is what ensures they get to that finish line.
So by making that connection explicit, that 150 line stops being just a line on a chart. It becomes the financial moat protecting the entire long-term thesis.
That's it. And you can reinforce it too. You can link the so-called smart money buyers who showed up at 150 to the people who are positioning for that future.
So the technical hold is proof.
It's proof that the belief in that $3.22 analyst target isn't just hope. It's structurally supported by real money betting on 2 years of stability. The 150 floor is basically the price of the ticket to the 2026 party.
I really like that framing, the ticket price. Yeah, if that argument gets tightened up, the whole report becomes a lot more persuasive.
Agreed.
Okay, moving on. The second major area for improvement here is about synthesizing the justifications for that $3 price target.
Yeah, that $3 target is the big promise of the whole piece. But right now, its foundation is a little split. I think that kind of diminishes its power.
How so?
Well, the justification for $3 is supported by 2 different pieces of data.
And they really need to be merged into one single unified thesis.
Right. Because right now, you have the $3 level justified in 2 separate sections. First, in the technical part, it's this massive fair value gap on the chart.
And then later in the fundamental section, it's just a note that the average analyst price target for AMC is sitting around $3.22.
They're presented as parallel facts, not as evidence that supports each other. And for a technical audience, that's a risk.
Why's that?
Because a fair value gap, as a pattern, can be seen as a bit high risk. It's a theory of price equilibrium. It's not a hard fact.
Right. Just to be clear for anyone listening who isn't a chart watcher every day, when we say fair value gap, we're talking about that liquidity void, right?
Exactly. That spot where the price moves so fast it kind of skips some steps. And theory says the market needs to go back and fill it in.
Balance the books.
Balance the books. But because it's a subjective pattern, a skeptic can just dismiss that $3 target as noise.
So we need an insurance policy.
We need an insurance policy. The suggestion is to combine them. Combine the technical gap and the analyst consensus into one single powerful validation point.
Use the fundamental analyst target of 322 to ground the technical reading of the chart.
Yes. And that fusion immediately solves the credibility issue. It takes the target from being a theory to being a consensus prediction.
I see.
Absolutely. So when you're talking about that technical gap, you have to transition right away to the fundamental targets. Don't just list them side by side.
You need to explicitly connect them.
Say something like, this technical gap toward $3 isn't just some arbitrary pattern. It aligns perfectly with Wall Street's forward outlook.
That link alone raises the credibility of the pattern. It suggests the chart is just reflecting a value that analysts have already done the math on.
And to really nail it down, you frame the 322 analyst target as the reason the gap exists at all.
Ah, okay.
You argue that the price is technically trying to fill the value that the smart money, the analysts who've modeled the 2026 slate, have already assigned to this stock.
So the technical indicator becomes the market catching up to the fundamental consensus.
That's the narrative. And that shift in framing makes hitting $3 feel less like a hope and more like an inevitable correction. It's a really powerful change for the report's structure.
It is. Okay, let's pivot to the final major piece of feedback. This one is more about what's missing. It's about getting ahead of the skeptic.
This is so important, especially for a piece that's this optimistic and urgent. You can't write a truly convincing bull case without, acknowledging and then shutting down the most obvious bear arguments.
Because the reader is already thinking about them anyway.
They're already thinking them, and right now this report is structured as, a pure bull case. The final graphic mentions risk, 150 breakdown, but that's it.
It totally avoids talking about why the stock is trading at $1.61 in the first place, even with this massive 2026 movie slate.
And ignoring that creates a vacuum of doubt.
Yeah.
A smart reader is thinking, okay, I know about the 2026 movies, but I also know about the debt, I know about the dilution. If the future's so great, why is the stock here?
And if the report doesn't answer that question for them, they're going to answer it themselves. And it's probably not going to be a positive answer.
Exactly.
But I guess my question is, how do you do that without killing the tone? If you bring in too much skepticism, doesn't it just slow down that high-energy, urgent momentum that the report is trying to build?
That's the key. You have to be strategic. You turn the weakness into the opportunity. The low price isn't a problem with the company. It's a failing of the market.
Okay, so the suggestion is to add a short, dedicated segment.
A segment that directly addresses that skepticism about the low price, and then you reframe it. You reframe it as the very thing that creates this incredible risk-to-reward opportunity.
So after you establish the technical floor and you solidify the target, then you just ask the question.
Exactly. After you establish that double-bottom pattern, the defense of 150, you pause for a second, and you hit him with that rhetorical challenge.
If 2026 is so big, why is the price $1.61 today?
Yes, you show the listener you get it. You understand their skepticism.
That's a strong move. It gives the analysts a lot more authority because it shows they're aware of the full context.
And then you answer it. You answer it definitively. Frame the low price as the market's temporary blind spot, or maybe an overreaction by shorts.
Right.
You argue that this panic selling is precisely what creates that undeniable risk-to-reward ratio you mentioned in the conclusion. The low price isn't a risk factor anymore.
It's the entry point.
It's the structural entry point. It transforms the low price from a weakness of the company into a fundamental mispricing by the market, which is, what every aggressive bull case has to argue.
And this is where the visuals come back in, right?
This is where that montage of Super Mario and Avengers and Spider-Man comes back. You use it not just as proof of future revenue, but as hard, visible evidence that the market has fundamentally mispriced the stock compared to that 322 analyst consensus.
That visual contrast becomes the definition of the temporary blind spot.
That's it.
This has been a really fascinating look at how to take an already strong data-driven report